Hello, welcome to another episode of SaaS Scaled. I'm very pleased to have Vipul with us. Welcome to our show, and please let us uh, know about what you're up to nowadays and a little bit about yourself and your company, please.
Hey, Arman. It was great reconnecting with you a few weeks ago. I can't believe a decade has passed by so quickly. Thanks for having me. Having me join the podcast. My background's a little bit unique, as we've both discussed. Spent half my life as a coder, co-founder, building a financial services data software business. We started that in the mid '90s, sold that in the mid 2000s, late 2005. And after that, I was really curious about, you know, when we first started that business, I didn't know anything about investors, VC, private equity, anything. So I got really curious about that. Uh, so much so to the point that I ended up joining the private equity team at Goldman Sachs, which is how you and I got connected through one of my mentors at Goldman, Raz. And so I spent the next 12 years investing in recurring revenue, predominantly technology businesses, and just learned a lot about how the other side of it works. And so that's been fun. There, I spent some time at Goldman. I was at a startup fund, then was running a fund with a friend. Uh, it was really fun to see that side. Then I had a chance to team up with the president CTO of our first business, who's my current co-founder, a guy named Jim O'Neill, in 2019, and we started SaaSWorks. And that's actually combining the two things: my passion for being a coder, co-founder, and the passion for investing in finance and data. And that's what SaaSWorks does. It combines those two things. And we've built a solution to serve the office of the CFO. So that's me over the last couple of decades.
Fantastic. And then I have heard from you that, for example, founders, start a company and they think about revenue, and investors ask about revenue, and that becomes the center of their attention. But in reality, if we wanted to do it in a very smart way, we should really think about quality of the revenue, and not every revenue is the same. Can you expand upon that topic, please, for us?
Yeah, I mean, that's a terrific topic. It's a topic we focus on a lot at SaaSWorks, insight on how we're building the business. In quality of revenue, it's not a term that's used that often. There's quality of earnings that people use a lot. Quality of revenue is really focusing on saying not every customer is made equal, not every dollar is made equal. What's the right thing for your business? What's the right thing for your customer? When you solve for quality of revenue, you're saying, let me find the most highest fit customers, which first and foremost is best for the customer. That means your product, your platform, your solution, whatever it is you're providing from a SaaS standpoint, is just a great fit with that customer. And people talk a lot about product market fit, and that's part of quality of revenue. Uh, Now, on the flip side, internally for your team, for your business and growing the business, the more high fit customers you have, the better, because you're going to figure out, hey, my product market fit. You're going to understand when that occurs sooner, because the feedback loop from customers that are really meant to use your solution is different than the feedback loop that comes from customers that maybe just are not a great fit customer for you, and you're not a great fit solution for them. So now the emphasis online, or when you talk to fellow entrepreneurs or investors, there's a lot of emphasis on quantity of revenue. That also matters. But if you can, as you're scale, particularly as you're scaling your business, if you can obsess on quality of revenue over quantity of revenue, it has a lot of implications on how happy your customers are, how you're serving them, how you're growing, and how your revenue compounds. Like, one, just to give one example. So for us, we found that our platform works really well with businesses that have 10 to 20 million of ARR on the low end, and upwards 100 millions, of ARR on the upper end. Now, if I try to go sell to $1 million ARR businesses or $1 billion ARR businesses, it's not going to be that great for my customers and it's not going to be that great for us, right? Now, someday we may evolve into that, right? So your quality of revenue and your definition of what a great fit customer is going to change. So that's the customer side of it. Internally for your team, particularly as a CEO, you've got to focus on saying, am I serving up good customers for the team to manage? And do they have some similarities? So another term that comes up a lot is ideal customer profile. And that's what that refers to is like, are you selling to your ideal customer profile? And when you have that ideal customer profile, your team, everybody on your team knows what to do, what makes that customer happy, what helps them stay longer. And for your product team, they know like, okay, we got some good feature feedback. And this is from a customer that is a great fit customer. It's high quality of revenue. Let me prioritize focusing on features of like that. Let me know if I'm answering your question the right way.
Yeah, absolutely. But also, it comes to my mind that if I'm a founder, one of the things that always I will be concerned about and pay attention to is my market size. So, and what I hear from you is that you need to be a little bit more selective with your market because otherwise you're not going to be able to serve your customers the best you can, and it lowers the quality of your revenue. Now, how does it work if it limits my market size too much? And it may impact my growth negatively as well. Because if my market size is getting too small, everybody would ask me question, what's your plan for growing to a certain size? Now, if my company is trying to really just stick to a particular size and just have a very good profitable business out of that size of the market, that's fine. But if my idea is to grow fast and get to a certain revenue very quickly, how do you address that? Does it conflict with the quality of the revenue in that case? And how do you think you would you would advise the company to do to navigate through that?
Yeah, I think that's a terrific question. These things don't have to be mutually exclusive. So I think of, if you can, my strong preference is focus on quality of revenue and quantity of revenue. They're not mutually exclusive in terms of how you think about it. Similarly, focusing on high fit customers today doesn't mean you're serving only that customer base tomorrow. So even for us, we started really focusing on 5 to 50 million of revenue ARR for the customers we were serving. And then we learned like, wow, we're doing better with 10 to 100. We're doing better with 10 to 200. So adding different elements to your market and your TAM, I think you can define your TAM and what you're targeting today, and you can do that separately, right? Because TAM is your total addressable market. What are you targeting today? And if there's a lot of pressure to grow fast, I think if you can grow smart and fast, um, that's what's worked out better for me over the years, and even in businesses I've invested in. What I found is that for a company that has really nailed it with a given set of customers and then scaling it into adjacent areas, whether it's going up in revenue size in different verticals or different industries, expanding the TAM from a solid foundation is much easier than having a massive TAM and your team internally, whether it's product, sales, engineering, customer success, they all feel like, okay, we're boiling the ocean. We have this massive TAM, but I don't know where to start or stop. So I don't worry too much about constraining TAM just by focusing because it's in your power to start to expand TAM either through product features, vertical focus, different sales teams. So I would not look at those as being mutually exclusive. And sequencing them, there's so many companies that have demonstrated the ability to start with small businesses, go to medium-sized businesses, or start with large and come down to small. Our first business, we were mostly selling financial services software. It was a data software business to small regional banks. By the time we sold the business, we had Citibank, State Street. So we had the small regional banks and we had the mega banks. But we opened up those layers of TAM when we were ready. The product was ready, the team was ready, and we had the right set of bona fides. Now, we just as easily could have started the opposite way. Start with State Street, Citibank, and then go down market and serve the smaller regional banks. So I don't
Yeah,
think it's a binary choice.
no, that's a great point. And also, I think when you think of it as a kind of revenue and the cost of revenue, obviously, when you have existing customers that you can grow them, it's the most economic way to bring revenue from existing customers and upselling versus going and acquiring new customers all the time. And I think the approach that you are suggesting, it increases the chance of really growing existing customers because now the quality of revenue is good and there's higher chance for them to really expand what they do. And of course, it depends on the product and services offered, but for most part, the quality of revenue being higher, it increases the chance of getting more revenue from existing customers that in turn it actually brings down the cost of customer acquisition. And those all are good kind of parameters and metrics and unit economics for the business, for the SaaS company, I believe.
I think that's spot on. And, in my perspective is going to come much more from B2P sales team driven sales, meaning people going on onto your website, buying anything at any time without any salesperson involved. I have less exposure to that. I've invested in businesses like that, but I've not operated in businesses like that. So in the context that you're giving, if you're making a sale, right, or the customer is buying from you, then there's opportunities for you to deliver more value as time goes. And the more clustering you have with higher fit customers, you're also going to get better feature ideas. That's going to lead to more upsells. You're going to get adjacent product ideas. Uh, that's absolutely right. And for those types of business models, the cost of losing a customer is real. If you think, if you have a lead to 2% conversion rate, that means you got to process another 100 leads to get to two customers. And that's a lot of time on the marketing side, sales side, customer success side to keep that. Whereas if you can bring in more higher fit customers, the velocity might feel a little bit different, but the compounding effect is much more powerful. And quality of revenue has an element of thinking about, okay, I'm going to compound my revenue. I'm going to grow my revenue, not just through continuous acquisition, but I'm going to compound the revenue by having stronger retention, higher net dollar retention, right? If you can have good gross retention and good, net dollar retention, that's going to compound the revenue in a faster way. But the other implication is you brought up customer acquisition costs. The size of your team, revenue per employee is becoming a metric that a lot of SaaS companies are being asked to follow now. Well, if your customer acquisition cost is really high, you don't have great fit customers. Let's say there's a mix coming in, you're going to need more people. Because when a customer is not a high fit customer, it's going to take more to service them. Whether you're servicing them through feature, more support tickets, whatever it might be. And that is also going to change some other areas. But on quality of revenue, uh, you know, those things really do matter. And quality of revenue drives your multiple and multiplier for the business, at least for the SaaS founders that are going to be raising capital. And what do I mean by multiple and multiplier? So the multiple is, what multiple do you get? Let's say you're a $10 million ARR business. Why do some get 5 times ARR? Why do some get 10 times ARR? Why do some get 20 times ARR? And I'm leaving kind of very early stage startups out of the mix because that can be more idiosyncratic. A lot of that is driven by quality of revenue. Because quality of revenue will impact your multiple. They'll say, okay, wait a second. They really know what their best segments are. Look at how long these customers are saying, the lifetime value, and even the sales and marketing spend they're doing. They're always looking at which segments are good, pressing their bets in the right segments, and pulling their bets in the segments that aren't working. And from an investor perspective, it'll seem intuitive as we talk through this, but they want quality of revenue because that revenue is going to compound better, because when those customers stay longer, you're not acquiring as many customers. And then to your point on upsells, happy customers that stay a long time with innovative SaaS companies, they're much more likely to try out the next solution you build. So that also grows the revenue in a different way. Hence my comment on quality of revenue impacting the multiple and the multiplier being the size of your revenue.
Fantastic. There was a point in that you realized that this is really what you are going to work on. Uh, my guess is probably as you were working with different companies, with different projects, you got into one particular case, maybe one client that had that pain, and you thought, I can solve this problem. Was that kind of aha moment, or it was from your perspective, it was gradually getting there? It was not like one particular thing in one day initiated the whole project that you had in mind to start, you know, your
Yeah,
company at that point.
yeah, you're asking great questions. I'd love to say that there was one magical moment in in the 12 or so years that I spent on the investing side, being on the other side of the table for SaaS companies. What I noticed is from when I was an associate to an MD to running a fund, like I got to look at 1,000+ businesses over time, and you start to see a pattern on who gets funded quickly, and who gets funded with a valuation that the founder is excited about and the team is excited about. And what I noticed is it were businesses that really had a very crystal clear view on these are great fit customers. This is why we spend time. And they demonstrated a tremendous amount of discipline around that and focus around that. And I'll share with you some examples, but you see these examples over a few years, and it started to click for me. I was like, hey, there's a theme here. A lot of the rhetoric and messaging out there is like grow, 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 grow. Grow as fast as you can. And then the moment you get to a series B or C, it flips very deliberately and very quickly to, okay, but tell me the quality of your revenue. Are you selling to in-ICP customers, et cetera? So seeing those patterns, and you have these aha moments. So there, an example was there was one customer, one deal I looked at, and they were trying to look into, okay, do we think this business can grow? What's the TAM? What's the, like, what's the possibility of a return for us if we invest in this business? And you're sitting there listening to the pitch from the CFO and the founders and the team. And when they give you three examples and say, okay, well, here's the industry we serve, it's huge. But let me give you three examples of why we have prioritized our marketing and sales efforts on these kind of customers. And one example was, okay, we're in health and wellness, and we have found these two specialties where we are spending a lot of time selling to them. And the reason is they never ask for a discount and they never leave. Now, put yourself in the shoes of an investor. If you can have that data and understanding at your fingertips and know that those are great fit customers, then that's great. Now, as investors, we were like, well, but those are tiny customers. And the answer was like, but they're great customers. And we're like, well, what about your bigger customers? They're like, well, believe it or not, the LTV to CAC is worse on my bigger customers because they ask for a lot of discounts. They don't stay as long. But intuitively, like, Armand, if you and I are thinking it's like, okay, bigger is better. Well, it's not, right? The quality of revenue and that customer selection. I love your words. That really matters. So for that company, by the time we invested, we're like, you're right. You should actually focus on the SMBs and forget these bigger customers. Still take them, but now empirically you've shown us. So that was an example. And then we've seen the flip as well, where it gets exciting, where you're bringing on a high volume of logos, and you think this is great because it's showing in quarter growth. But the medium and larger size businesses are who's really staying with you the longest, is happiest with the product, but there's less velocity, there's less excitement, there's less volume. It starts to feel a little bit boring when you're doing that. And quality of revenue does have a boring side to it because it's more wash, rinse, repeat, saying, hey, these are the customers that are so happy. And so my shout out to the founders is there's good boring and bad boring. The good boring is when you find a great customer selection process, an ideal profile, and have the discipline to say, you know what, I know this is boring, but these are the customers that are really, really happy. Let me just keep selling to them because there's nothing better than just keep selling to happier customers. And I know this sounds ironic or natural, like why wouldn't anybody do that? It's just more boring. It's not as exciting, Armand. I mean, I loved when you and I first met. You were so clear. You're like, Vipul, we have three segments we sell to. Here's where we're experimenting with businesses like SaaSWorks, right on the small end. Here's our bread and butter. And we're seeing some excitement from larger companies. That's a really, you've done nothing to shrink your TAM, yet you know exactly, and you're leaving room for experimentation in. You're getting me excited on this topic, so I'm going to talk too long. I'll hand the mic back to you.
No, that's great. Actually, I wanted to ask you exactly the point that you mentioned, that sometimes, you know, in SaaS companies, we go and start selling and it's fun and you are bringing new customers. And normally that happens after you have worked extremely hard to get to the point that you can sell, meaning that, the first phase of building product is done and now you're ready to offer something to customers that they are willing to pay for. And then you sign up these customers, and at that point you're happy that you accomplished that. But as you said, this is just phase A. Now soon you are going to start phase B, C, and it's good to know the next moves. Now at one point you may come back and say, okay, I did an experience and now I know a lot that I couldn't possibly know before. And I'm serving three segments of the market now, segment A, B, and C. But when I look at these metrics, then I realize that actually segment C works best for me. But at that time, it might be tough to turn off segment A or B because that's real money coming to you, even though they need different expertise in your organization. You are not as effective as you could be in segment C. And since it's just the existing revenue, existing customers, you just continue with it because that's the status quo. And then it's hard to just shut it down and say, let's just shut it down. Let's just get rid of a segment A and B, and our revenue will be half starting tomorrow morning, but then we are going to grow much faster. I'm not saying companies don't do this. And at one point in my life, I had to do it. But based on your experience, how hard it is, how often it happens, would you even suggest that to happen? Or you may advise founders that, just keep all three segments, but don't grow A and B and just stick to C. And in long term, maybe 5, 6 years from now, then segment C is what you are doing.
Yeah, I mean, I think once, if you're lucky enough to identify that segment C is your best segment, then, I know you like asking, what books and publication things, this, I have to work this in. The hard thing about hard things. One of my favorite books, if you're a startup founder, and they just highlight a lot of different tough decisions that you need to make. So if you're lucky enough to figure out that, hey, segment C is working really well, then it's one thing to say, okay, I'm going to just shut off segment A and B. I think if you can do that and your balance sheet, your cash flow supports doing that, do that sooner rather than later. Let's say if you can't, maybe you apply the 80-20 rule, but the more time you spend after finding out that segment C is working, the best for your customer, for your team, for everyone that's involved, all the stakeholders. It is a really hard decision in one way, and it's a really easy decision in another way. You wouldn't deliberately climb a mountain with a bag of rocks in your backpack. And that's what you're doing when you hang on to segment A and B. Now, there's this sunk cost fallacy that's really hard, and I'm empathetic. I've lived it. It's hard to just say, wow, there's revenue coming in, they're paying us, this is working, but in the end, you're doing everyone a disservice by holding on to something that you know is not a great segment. Now, that's, to me, you cannot do it soon enough. And I equate it, Armand, to think about cultural decisions. If there's something going on in your culture that doesn't work, I can't think of a CEO that would ever tell you, hey, I didn't make this culture change fast enough. They always feel like they made it too slow. Think about this as the culture of your revenue and the quality of your revenue. Don't let the bad culture seep into the quality of your revenue, right? Because it impacts the customer, it impacts your team. I don't like, if you're lucky enough to find C, you can't shift all your focus to that soon enough, in my opinion. And
Yeah,
those
and that's
businesses might have a short-term low. they will grow much better, much faster.
Yeah, to be honest with you, as you said, it's not always as clear as black and white. There are so many shades of gray, and then sometimes they are okay. They are not terrible. It's just segment A. For example, there are some other characteristics sometimes. I do remember at one point in one of the businesses I was involved in that segment A was actually great for our cash position and it was bringing us quick cash. But segment C was the one that actually long term we knew that it has the merits and it can really expand the business. So sometimes you really keep one segment for one characteristic and then the other segment for the other. It's a multi-dimensional things, and that makes the whole kind of business exciting and interesting because it's not as simple as just looking at two numbers and making the decision. It's just so many dimensions you have to analyze at the same time, and it's dynamic. It's just changing over time and you have to keep an eye on it, and it changes from quarter to quarter and year over year. But that was really in reality what I personally faced in some cases.
Yeah, and we on our first business, we faced a similar reality. So we built our first business right when the internet was happening, which is why this is an exciting time to build if you're a SaaS founder right now with the advent of AI happening. At that time, this was in the mid late 90s, so the internet was really happening.
Mhm.
But our first two products, which were very high margin, were desktop products, right? Had client server technology. We did exactly what you said. I think if you're doing it knowingly, deliberately, intentionally, and saying, hey, I'm going to keep, because these customers are actually happy, they're on a desktop product. It takes one or two engineers to maintain it, and it's also giving me leads. So not only are the customers happy, the cash flow is great, distraction is limited, and we've made sure that we're not distracting what's working with the internet product from that. We did actually keep both sets of solutions going for almost 5 years.
Mhm.
Uh, and customers on both sides were happy. And then, like, one unintended benefit we had was, okay, this is great. Those customers were turning into leads for our internet focused business. And now, if it's giving okay cash flow, bad fit customer, you're having to continuously invest and distract your best engineers, then I would say you got a tougher decision to make. But if it can be in maintenance mode and it's actually fueling innovation in the other newer products, like you were describing in your scenario, then yeah, I mean, things are rarely binary,
Mhm.
right? It's
Yeah.
quality of revenue and quantity of revenue. I think if you only focus on quality of revenue, you might be growing at 10% with most amazing revenue and it'll take forever to compound.
Yeah.
So you've got to look at both. And I like what you said. It's never really binary or black and white.
And then, right now we are in a particular macro climate situation, especially for SaaS companies. If you look at the amount of investment coming to SaaS, especially enterprise market and B2B market, and if you look at that, it's just it's going down year over year, and 2023 was probably the lowest among the last 6 years or so.
Yep.
So when we look at this kind of climate, that essentially SaaS companies are under pressure, and there is more emphasis on being cash efficient, and cash is expensive. Do you think that automatically, not automatically, but that in a way it encourages more companies to really think about their quality of the revenue? Because at this point, anyway, if they don't have that quality or the minimum required quality of the revenue, it's hard to survive at this environment that everyone tries to cut costs and minimize the expenses they have.
Yeah, I'll answer that. I'll contextualize a little bit with, let's say it's a Series B or later business, or private equity backed business, or looking for private equity capital or growth equity capital, like those three, or maybe even you're trying to just raise some debt to finance your business. Right now, quality of revenue is what the diligence is heavily about. It's not the only thing it's about, but that is, in this environment where funding is tough. of any of these funding types I talked about, right? Whether it's Series B or later VC capital, private equity capital, growth equity, debt capital, everything everything's become a lot trickier in this environment we're in. So what investors are looking for is um, I can take a little less growth, but I can't take a lot of uncertainty. And so quality of revenue is going to speak to that. And we've talked a lot about how that impacts revenue in terms of when you have great customer selection, but how does that impact other metrics that people are looking at now and investors are focusing on? And two metrics um, for any of the CEOs listening, if you're running a SaaS business right now, the two metrics that should be top of mind, in addition to customer selection and things that Armand and I have talked about, is what is your revenue per employee and gross retention, and what's your gross margin? Because when the customer selection is not as focused as it could be, that's going to show up in gross retention and it's going to show up in gross margin. And therefore, it's going to show up in revenue per employee. You're going to need more people to serve that. And that, Armand, comes straight to your point on capital efficiency. People want to see predictable, profitable growth. It doesn't mean your business is profitable, but is your growth profitable, right? And so that is a core factor. And we see this in our data right now. We have, well over $1 billion in revenue we monitor every day on our platform. And we're seeing where a lot of the focus is. And it's been great to see that there's growing focus on these metrics. And investors are talking a lot about it. I was with an investor yesterday who was introducing us to some of their portfolio companies. And they said, listen, as you guys work with any of our portfolio companies, the three things we want them to focus on is, for them, it was revenue per employee, gross retention, uh, and net dollar retention, right? And for different investors, it's going to be different things, but you are going to see revenue per employee, which is a way of figuring out capital efficiency. It is going to come up a lot, 2024 and beyond.
Yeah, fantastic for the and great insight. So at this point, I would like to ask you if there is any book or publication you would like to share with our listeners.
Yeah. So the hard thing about hard things I mentioned, that's a great book. I'm sure pretty much everybody on your
Mhm.
podcast has probably already read it. It's a classic for the startup side. Um, I just finished Never Split the Difference by Chris Voss. The CEO job is very hard. It's lonely at the top. You're having to choose between really tricky things, and the most common desire is to split the difference. Don't. Got to make the hard decisions. And then as I think of events, this is a little bit personalized. I like smaller events. I like more targeted, where the event also has this sort of customer selection that's going in. So I'll mention this was my favorite event last year. Armand, I think you would love it.
Mhm.
It's in, of all places, Birmingham, Alabama, which is where we built our first business. And
Mhm.
there's an event called Silicon Y'all, which
Mhm.
is hilarious. As anybody that's from Alabama or the Southeast,
Yeah,
you got to love that name, Silicon Y'all.
yeah.
And it's terrific. 85 CEOs, 15 investors,
Mhm.
and the content was fantastic.
Mhm.
And so I like events like that. And then if you're looking for something bigger, Primary VC in New York does a summit every year.
Mhm.
It's gotten bigger and bigger. I think it was up to a couple thousand people. Terrific content. I'm a forced extrovert, so going into something like SaaStr, not my thing.
Mhm.
I'm sure those are great events. It just doesn't fit my personality well. And then I like industry specific events like Money 2020, which is a big event, but somehow is very, it feels focused and targeted. And we are serving the office of the CFO. So that's a good event for us. So those are examples of things I've enjoyed. But there are these really amazing small events out there.
Mhm.
If you can find them locally, I find the content to be richer and more conversations with CEOs where you can learn from each other. And not just CEOs, from any kind of person that's attending, because they're all focused on kind of the same thing.
Yeah, that's good. No, that's great. I appreciate that kind of insight because finding the right event is not as easy as someone may think, right? So it requires asking and knowing and some of these, and there are a variety of events, but sometimes you go to the event and you come back and not every single event is the same from your experience. So it's good to hear from peers that what is their experience with these events, and definitely that is helpful. Again, thanks very much, Vipul, for having you. It was always great to speak with you, and always insightful and inspiring me. So thank you very much for this
No,
discussion.
thank you. I think you asked a great question. You made it easy for me.
Thank you.
Thank you.